Hi, this is Elle with Realty.ca. Today we're excited to have Lorne Andrews, who's mortgage broker and founder of Dominion Lending Expert Financial. He's here today to inform us about new situation. Hi, Lorne.
Hello, Al. How are you?
I'm fine. How are you doing?
Good. I love your backyard.
Yeah, I like yours.
Thanks. I'm on my deck, right? So it's the you get to work from wherever you are. That's the good thing about what we do, right? So it's awesome, and everybody's kind of doing that right now. Anyway.
Exactly. That's nice.
Good. So what are we going to talk about today, Al?
There are lots of buyers. They have the same question. Buying
Okay.
in today's market, is it a good time, Lorne?
To buy in today's market?
Yes.
Okay, so let's put it this way. One of the safest, best, most consistent investments that you can ever have is real estate. Okay, so and that's been consistent over the times. Now, with our situation, the way everything's unfolded, unprecedented is interest rates, like crazy low interest rates. The fact is that you can buy something, like I just did an approval yesterday at 1.99 for a 5-year fixed mortgage, right?
Really?
So
1.99. That's
1.99.
awesome.
That's a 5-year fix. It's not even a variable rate. They could have got a little lower the variable rate, but so when you look at the cost of borrowing right now, to get into a home, 100%, I would say it is a great time to buy. There's probably been no better time to buy. There's a lot of other factors. We'll get into some of those later on, but as well as I know is it's in real estate itself, equity is built over time, but it's always been really, really consistent in terms of year over year, the growth of your investment. And particularly people that are renting right now are thinking, okay, what is my cost to get into a home, and what is my monthly carrying cost to carry it? And a lot of times, the purchasing a home could be cheaper on a monthly, from a cash flow perspective, month to month, and you have your own asset to do it. So Elle, I would say now is a great time to buy.
Wow, that's awesome. And as you know, there are lots of first-time buyers getting into the market. So what is their minimum down payment, and what programs are there to help first-time home buyers?
Oh yeah, that's a great question. And you know what? I'm going to talk about, okay, let's talk about down payments first, right?
Sure.
So when you're buying a home, okay, the minimum down payment that you need to do is 5%, and it's 5% of the first 500,000. So of a mortgage, okay. So, sorry, let's say if it's a purchase price of 500,000, I can put $25,000 down. That would be my minimum. The portion that goes over the 500,000 up to $1 million, I need 10% of that portion. Okay, so if I'm buying a house for 600,000, my minimum down payment is 35,000. Okay, because there's programs which are insurers, so CMHC and Genworth and Canada Guarantee. Those are insurers that allow you to buy a home with less than 20% down. There's an insurance premium that's put onto the mortgage, so the lenders pay it on your behalf. Okay, and then they just amortize it into the mortgage, so you don't really feel it too much. It's like maybe an extra $20, $30 per month as a payment because it's put into the mortgage. But what it does is it protects the banks. Okay, so because now it's insured, and it allows you to buy a home with less than 20% down. And the good thing about when you get into rates, so for example, and I get this a lot of time from people that have 20% down or greater, and they put a down payment and they're looking for a certain rate, and they don't get that rate, and you actually get a lower rate if it's an insured mortgage, right? So for example, that rate at 1.99 or 2.0 for a 5-year fix is for a high ratio mortgage. The same person that would put 20% down, their rate would be a little bit higher because it's not insured, right? So sometimes that confuses people. One of the other things I'd like to say too is that sometimes I get people saying, you know, what is the minimum down payment for a first-time home buyer, which was the kind of the question. But that's the minimum down payment for everybody. So even if you bought a home before, you can still buy a home with that minimum down payment. There's no restriction on you have to be a first-time home buyer to only put, say, 5% down on.
Yeah, many people confused. They think like it's just for first-time home buyers.
Yeah, no, you could have a home, and let's say, Elle, you know, you have beautiful scenery in behind you, but you want to go buy a cottage property. Okay. So you can go buy a cottage property and still put 5% down on that cottage property, because it's still it's like a second home, right? Mm-hmm. So you don't have to put you don't have to put 20% down or anything else like that. It's only when you get into investment properties, like rental properties, they need 20% down. So that kind of covers the down payment. So then the next part of your question, I believe, was, you know, what kind of help out there is there for first-time home buyers? So,
what
you know,
programs?
trying to get all this money down. So a couple of things government has in place is, one is RSP. So you can use RSP savings up to $35,000 per person as long as you're a first-time home buyer. Okay. And what classifies you as a first-time home buyer is that you haven't owned a home, say, in the last 5 years, right? So if I bought a home, I own a home, and I sold it, and say 5.5 years later I go buy another home, I could use my RSP again, right? Because now I'm classified under that category as being a first-time home buyer.
That's a great information. I think many people don't know about it.
Exactly, right? So you can use, that's where you would leverage it if you haven't owned a home at all. The other thing that is in place is when first-time home buyers are buying a home, there is a land transfer tax incentive. So there's rebates that they get on land transfer taxes. Now those ones, if I've claimed it once, and even if I owned a home 10 years ago, I'm done with that one. I can't claim the land transfer.
So one-time use only.
Multiple times, yeah. So even if I haven't owned a home for a long time, but if it's a case where you're a brand new home buyer, there's you get a land transfer tax rebate, so you can save money on the closing. Other programs they got, so there's a shared equity down payment program that the government came out with, and basically that's if I have, let's say I have 5% down and I'm buying a resale home, and as long as the total value doesn't exceed, say, 400, so the total mortgage doesn't exceed 480,000, okay? And there's other things that factors in this, but there's a criteria. As long as you fit within this criteria, the government will give you an additional 5% down. So it could help you qualify for more, all right? But the issue with that particular program, in the GTA, it might work for some condos and things like that, but most of our homes within the GTA are often priced beyond that range of where you would fit into that program. But in other places outside of the GTA, in some rural areas and other smaller towns, it could work for sure, right? So what we do is we look at that particular program and make sure it's suitable, right? Mm-hmm. Because it's also a shared equity program. So if I sell my home, 10 years from now, I have to pay them 5% of whatever the new sale price is. So they get a shared equity in basically my home. If I lose money, the house loses money, which is rare, but yeah, that's the case, then they would actually get less, but chances are they're going to get more. So you always still have that, you still always owe them, right? So,
exactly.
And sometimes when I work at using this program, because the other criteria is you can't, the maximum mortgage can only be 4 times the amount of your total combined income. And sometimes people will actually qualify for more by not using that program. So it's something that we look at and evaluate and give as an option, and weigh out the pros and cons about that particular option, and make sure we educate our clients to understand exactly what it means. And sometimes it makes sense, sometimes it doesn't. But it is another program that's been put out there to help first-time home buyers for sure.
Wow, that was very complete info regarding first-time home buyers.
Yeah.
And another question, nowadays because of the COVID, some people they has been temporarily laid off because of the COVID, and we are wondering to know, can they still get a mortgage?
Um,
Because they
okay,
might have a
so
plan before to buy, and then now they're
yeah,
laid off temporary, and they're thinking, can they get
yeah,
a
okay, so it's a tough situation because at the end of the day, the lenders are going to look for what income you're showing and make sure that income is consistent. And because we're kind of like in uncharted territories with this COVID, they want to say that, okay, so let's say somebody's salary, they've been working at a company for a long time. COVID or for whatever reason shut down that place, so now they're taking the subsidies.
Yes.
Other things, they're not working. Okay, what the lender is going to ask for is they're going to say, listen, we need to make sure they're back to work. Okay, so we would need to see a recent pay stub and confirmation that they're back to work. At that particular time, they're able to use that income again. Not until that time though, right? So
Yes.
if you're in that situation where you think, oh no, my company's going to call me back anytime, I can go buy something. No, let's wait. You got to wait until you're actually back at work, okay, and make sure that in that particular case, yeah, you show that you're working again.
Yeah, that's good. So we want to know, is COVID playing a factor in financing when clients are buying if they're working?
Yeah, so here's the thing, right? So when this thing all came out, you saw the banks and everybody else saying, hey, listen, you know what, you need help, we'll ask if you want a deferral on your mortgage payments.
Mm-hmm.
It's available for you. Credit card companies were saying, hey, call us, we'll adjust your payments. Loan companies, if you had a car loan, you could defer your payments and things like that. So there's three things, there's a few things we need to ask, okay, when you're starting off. One is when applying for a mortgage, we're going to ask if you have an existing mortgage, like a rental property or other places, we need to know, have you asked for a deferral, right? So yeah, give you a scenario that we had somebody come in, they want to buy an investment property, right? Yeah. So they give us all their income stuff, everything looks good, and whatever, we pull the reports out, and it shows that they have a mortgage deferral on their owner-occupied property, right? And we're like, well, you have a deferral. They said, yeah, it's got the deferral, yeah. But you're still earning income because we're showing the lender you're earning income. How do you have a deferral if you're earning income? And they said, well, I was in the bank manager, and they said, oh, just apply. Everybody's getting it. It'll help you just in case, right?
Yes.
So lenders are like, we can't lend if you have a deferral, right? Because it's telling us you're not making money because you've asked for the deferral, but you're showing us you're making money. So which is it, right? So
exactly.
So in that particular case, we need to make sure the deferrals are removed. We have confirmation that deferrals are done and everything's back to normal. Then we can proceed with that. Okay.
No.
All right. So there's that. Okay. So then there's the other thing. Everything looks good. All of a sudden, a bureau comes up, and it's something that shows up called emergency. I forget exactly what it's called, but this big flag within your credit bureaus that says, so for example, if you've done any type of credit card adjustment or any type of loan adjustment, it's some natural disaster or something like that on there or whatever. So you see this big natural disaster pop up at you.
Even deferral mortgage is as a red flag?
Deferral mortgage just shows deferral mortgage. It shows that there's no payments. There's ways that it shows up in bureaus, right? So when that's why it's important. It's important to let your mortgage person know that these things, yeah, I did this, so they can help you navigate. Say, okay, this is what we need to do in order to get to that next step. Because all of a sudden the lender sees, okay, there's credit card deferrals. They say, hey, we can't proceed until these are done, right? So you got to remove the deferrals and everything else. So those are some of the things that's thing. And one other thing that's popped up too. I know none of your people are going to be doing this. It's okay, but it happens, right? So let's say, for example, you're buying a home, right? Mm-hmm. You got income documents and everything else, and the lender says, okay, great, let's prove the down payment. Just need to see 3 months bank statements, and you print out the 3 months bank statements, and you see served government subsidies going in to your account because they've applied for the $2,000 subsidy from the government. Well, how are you making money that we're showing the lender and collecting these payments all at the same time? Can't do it, right? You're not supposed to do it. So the lender's like, how does this work, right? And we're like, oh. So those are the type of things we ask those questions ahead of time, because COVID can kill mortgages. They can kill these real estate deals if they're not navigated properly. So it's making sure that you're forthcoming with details. Like, I think that you got to think of, you know, when you think of a mortgage broker, think of it as your pilot on an airplane. And if that pilot needs to know all the dangers, he needs to know where the turbulence are. He needs to know how to navigate around it. But if he's not given all the information, he has to react to whatever is done. So if you give that information, it's like going to the doctor and not telling him your symptoms and expecting him to give you a great diagnosis, right? So we need to know everything, because there's different ways that we navigate through the lenders based on your scenario and your situation, and that's really important. So knowing that stuff up front, and you know, from the consumer's perspective, they don't know the difference. They're sold on, you know, hey, take the mortgage deferral, take this, like it's relief for them. So like, okay, it's being offered to me, I'm going to take it, right? They don't know, right? Right. So it's not the blame. There's no blame on the consumer. It's probably more blame on, you know, nobody tells you.
Exactly. Nobody educates them.
If you start doing this is what's going to happen, right? So they're not
And
assuming.
then they regret.
Yeah, right. So it's just like, you know, it's like eating the chocolate cake and you just regret it in the morning, right? So that type of thing. Tastes really good at the time.
It's a good example. I like that.
Yeah.
Lorne, on July 1st, CMHC made 4 policy changes. What is CMHC's role in real estate, and how did these changes affect buyers?
Okay, that's a great question. So CMHC, I think I touched upon this in the beginning, that there's 3 major insurers of CMHC. There's Genworth, and Genworth just got bought by another company, so their name will be changing soon. They haven't divulged what that name is. And there's Canada Guarantee, which are the 3 major insurers, right? And so, again, if you're putting less than 20% down on a property, these insurers will insure that mortgage to allow you to do that. The banks pay the insurance company, and they just take that and they put it into your mortgage and amortize it over the 25 years, okay? And allows you to buy that house with less than 20% down. Now, with those insurers, so CMHC is kind of a different animal, because they're kind of really connected to government, you know, that type of thing. And they like to come out and kind of be the lead on dictating policies. And they came out with a prospectus saying that they were expecting home values to decrease by about 30% in Canada. Now, I'm not a big fan of the way CMHC has done a lot of stuff. So if you remember when they came out with the stress test, right?
Yes. Exactly.
So the stress test is basically, for those of you that are brand new, whatever. So if remember, I talked about those great mortgage rates of 2% or 1.99.
Yes, 1.99, yes.
Right? In the old days, if I had a 5-year mortgage at 1.99, I would qualify it using 1.99% over the 5 years, and that's how we qualify. But what they did is they said, okay, no. What if interest rates are to go up in 5 years? We need to use a different benchmark rate, okay, to qualify people so they know that they can afford mortgages 5 years down the road if the rates are to go up so much. So they started coming up with these things. So right now, that benchmark rate that you qualify at is 4.94%, right? So considerably amount higher. And what it does is it reduces what you would qualify for a loan by, you know, sometimes $80,000, $100,000 based on what you would have qualified for before they had that stress test. So now, and I understand maybe there is an importance of a stress test, but the thing is that if I'm paying off a mortgage, especially when rates are down as they are right now, you're distribution of what you're paying towards interest and principal, your principal is now much more higher than the interest, right? It used to be the other way around.
Yes.
When you had a higher interest rate. Now it's like this, right? So you're paying more principal. So in 5 years from now, my principal is actually going to be down a lot more. So on that new calculation of what that interest rate is, it's going to be less payments anyway. But anyway, they didn't really, when they started doing this stress test, there's probably a better way they could have done it. I'm not saying there wasn't something that was needed, but they kind of go out on a limb and say, no, this is how it is. And they don't really consult with, I think, industry people.
Are they going to modify this?
Yeah, they talked about modification, and they said what they're going to do is do more of an average. So that would have lowered the stress tests moderately, right? So it would have made a little bit of a difference. But then they kind of suspended that formula that they were going to do once the whole COVID situation happened. So you got this stress test. So they did that. Okay, so that was the one thing that they did. And then, I mean, they came out with other things, like there was the suggestions for the foreign buyers tax, you know, the 15% and things like that. And so, and maybe some of that was necessary. So I'm not saying all their decisions are bad. But then this whole latest thing, they said, hey, you know what? The house values, right? Because of COVID are going to decrease by 30%. We're potentially going into a recession. People are not going to have jobs. And now people are buying houses with just 5% down, and house values decrease by 30%. They're going to have no equity in the property, right? It's going to be over mortgaged, right?
Yes.
So they said, we're changing our policy, and now you have to have a credit score above 680, okay, to get an insured mortgage, or at least one of the two of the applicants has to be above 680. They changed what's called the lending ratio. So basically, you can always borrow a certain amount relative to your income, okay? And what they did is they lowered that amount. So it decreased dramatically what you would qualify for first-time home buyer. And
so
also
the amount of 80 to 100,000 that you mentioned at the beginning, like you said.
It was so basically what they did is there was if it was credit score had to be above 680, and then when they adjusted what's called their GDS, which is your gross debt service, basically all your shelter costs relative to your income. Used to be 39%, went down to 35%. That lowers what you qualify for, like on a $500,000 mortgage, maybe 40, 50,000, right? So it's considerable, because what it did is with what they were doing is now putting those first-time home buyers that were so close.
Yes.
It's like taking that chocolate cake that you really wanted and just moving it away, right? So and the thing is that, but it's healthy chocolate cake, because you know the chocolate cake is going to be good for you if you get it, right? So and the thing is that what it's doing when you push things away, you have to understand that home ownership is almost the fabric of our environment. It's our communities. When you have ownership within the communities, there's so many things that happen from it. It doesn't happen to the same respect when people are renting, because people are very transient when they're renting from place to place. But once you ground your roots, it's different. It's different for the community, and it's obviously different for the families, which is important. So with that, they came up with this new rule, and they said, no, this is it. Well, guess what? Genworth, the other insurer that usually always follows suit, they said, we don't get it. That doesn't make sense. You know what? We're not going to follow you this time. We're going to stick with our old rules.
That's
right?
great news.
So what it's done is it gave that relief to the first-time home buyers, because now it's like they're all worried now, what's going to happen? I'm not going to qualify. I'm going to have to save another 2-3 years before I can get to where CMHC has moved that target to. And Genworth said no. We believe in the Canadian economy. We believe in the communities and basically real estate in Canada. And they put their faith in that, and they said, we're not following suit with CMHC. The other problem with CMHC when they come up with these policies, it's like painting a canvas that is so big, all with the same brush. And the issue is that every area of Canada is very unique, right? So what happens in the GTA here with house values, where people are, the immigration, everything else that's coming in that helps, you know, say people within Ontario or GTA flourish, it might be different in Calgary, right? Or Winnipeg or other places that their economies are working a little bit different. Their housing markets are working a little bit different. Vancouver, different from, you know, the Maritimes, right? It's like totally different. So maybe what has to happen, and I'm not the person that makes these decisions, is that maybe you just don't throw the paint on the canvas and say, this is how it is for everybody. Maybe you have to look at the uniqueness of the environment of each of these provinces and areas and come up with suitable solutions that fit that particular environment, right? So yeah, that would be my take on that.
I think I agree because before I lived in a different province, so it's totally different environment from here. So
it is, right? And can you imagine everybody's the same rules? Yeah, I don't get it, right? It's like giving everybody the same prescription for a cold. Every cold is different, every virus is different, or whatever it is, and everybody's different, or same allergy medication, just have one, right? Let's just have one medication for everybody. It doesn't matter what the sickness is.
Yeah, it doesn't make sense.
Doesn't make sense to me, but I'm not the one that makes those rules, so.
But you are a good one.
Yeah, I know. Sometimes you just want, it's like you see some of the stuff on social media and you know what, you gotta be neutral, right? So, you know, it could be, and it happens, like there's some things you don't talk, politics is one of those things you kind of just, you want to bite your tongue, you want to get in there and make a comment, but you gotta stop because there's other people that are on the other side of the fence. There's somebody that's probably listening to this that, you know, maybe has CMHC t-shirts in their closet. I love CMHC. Let's make CMHC great again. Hats or whatever it is. They can be big fans, just hating what I say. And I'm not saying anything bad about CMHC. I'm just saying that, you know what? You got to think. Like, it's just, to me, it's common sense. But the problem is it becomes very political. Right?
Yeah, in reality, sometimes it doesn't work, as you mentioned.
Yeah. I would say that'd be, you know, how I'd sum it up. Right. So without saying more and getting into trouble. So
anyway, information that you provided today was very valuable. And I think we all educate in all those subjects that you mentioned. And I really appreciate your time and accepting our invitation. To all audience, if you would like to cover any topics, please let me know. I can arrange with Lorne for different sessions so we can cover those topics which is interested to you. Again, Lorne, thank you so much for your time.
My pleasure, Elle. It's always a pleasure to talk with you, and you know I appreciate the opportunity to maybe connect with some people. Hopefully, did you learn anything during this session?
A lot.
Okay, so good. Then,
for example, I didn't know if you haven't purchased for 5 years, you become as a first-time home buyers. So that was, you know.
For your RSP deposits, right? You can reuse your
RSP deposit. Exactly. Right? So that was a very valuable information.
That's good. Yeah, perfect, right? So, hey, listen, we're all solution providers. We're trying to get people and, you know, connect them with their dreams of being in a home, right? So we have to, you know, step up and make sure that we not only connect with, you know, our clients in terms of what their short-term and long-term goals are, but make sure that we take care of them along the way. And that's the most important thing.
Definitely. You are a person who's professional and you have very nice heart, and it's always been pleasure working with you.
That's very good. Thank you, Elle. And we're going to do this again soon.
For sure. Thank you and have a nice day. Bye-bye.
All right. Thank you.
Bye.